Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome back to the show, Bob.
Yep, Jim, here we are again. Always a pleasure to get together with you on Friday.
Panic stations 2 weeks ago. Has the panic resided, and have we finally started to climb our way back out decently?
Well, it's been a very good bounce, actually. I'm just looking at Bitcoin because that's sort of been the focus of the action, where the Bitcoin play, as we've been discussing, is a great bubble. There have been great bubbles in financial history, and they have similar characteristics, like a huge, compelling rush, a climax, and then bang, in this case, a correction. But the case of the Bitcoin thing is that, well, the action was similar to, say, the blow-off in gold in 1980 or, the stock market in 29. The price gains were without precedent in history. It was just quite remarkable. But nonetheless, it's human behavior and becomes, when it gets to a speculative rush, quite measurable. And on October 4th, we published that it looked like the markets were going to go into a bubble, and even the Dow Jones average would get bubbled, which it did. And then the next step was to then look for the times when previous really good speculations found a climax. And there were some good examples of what we call the turn of the year, like in December or January. And one of them was that gold mania in silver, in January the 21st, I think it was, 1980. And then the Tokyo mania, last trading day of 1989. And less of a mania, but a bull market top, was the New York stock market on January the 11th, 1973. So we thought, okay, if you're into a really a straight up market into December, that would be probably working on the top. So on December 19th, our technical stuff got what we called a sequential sell. And in looking on Bitcoin back 2 years, there hadn't been that signal generated in 2 years. So it was easy to say, well, we'll go into the biggest correction in 2 years. So, and that's what it is. Now, it's anybody's guess as to whether the speculative side of the bubble is over or not. But I have little doubt that the technological advance going on in Bitcoin and blockchain will continue. That's a given. But when you just look at the Bitcoin here, a couple of mighty whacks down, and the first technical break was taking out the 50-day moving average, and then it came down to the 200-day, right to it. So the high was 38 on this one, down to 960, quite a drop, and then we're now up to the $20 level, which in 2 weeks is a very nice rally. It's a double. And it's now just under the 50-day moving average. So whether it gets through or not, we can't tell at this stage. But it's also the setback in this particular frenetic sector did set back the senior indexes. So it worked well. The turn of the year model, we can say, worked. And then now on this rebound, I know I should go back to what of course the speculation went from the very intense high flyers, and when they cracked, and then a little while later, then the Dow and the S&P cracked and corrected. So it was the action in the senior indexes was sort of with the big hot flying stuff with the bitcoins and the marijuana stocks. So it's had a whack and is recovering. Now, for the investment side of the market, we could look to, in a year of pretty good speculation, which this has been, the credit spreads can have a little narrowing going on sort of out in April, May. And that would be a positive for the stock markets with narrowing credit spreads. Also, the industrial commodities, base metals, crude oil got hit. Lumber didn't. So that was also a negative for the overall stock market. Now, these have been rebounding as well. So with a sharp hit in the financial markets like this, there's bound to be some fairly important speculators offside on it. And typically it can take some time before this is discovered by the marketplace. So there could be some serious injuries there. The Austrian economists call it malinvestment. And I've been using somebody else's phrase, it's an old one, that when the tide goes out, it reveals some very nasty stuff on the bottom of the harbor. So the tide has gone out a little, but we can't see what nasty stuff is there yet. But there is potential for some misadventure to be discovered in places where maybe speculation went too far. Now, if that comes out, say, in the next month or so, that would be a setback for the markets. But generally, let's just look at credit spreads and the yield curve, often favorable around May, maybe into June. And the market could trade around here for a while and build more of a base. And then anything after mid-year is the time when the last of the favorable action in industrial commodities and in the credit markets could be expected. I mean, after that, you have a tendency for industrial commodities to sell off towards year-end. And if there's going to be any serious liquidity problems in the credit markets, that has a tendency to show up in the fall. So our advice is people to just be protected, don't have any leverage, and look after yourself as best you can.
We'll have more with Bob Hoye right after the break.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead zinc silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic Engineer gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE, symbol CRL, and the Pink, symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
Welcome back. We're speaking with Bob Hoye. Bob, you said just before the break, look after yourself, no leverage. Well, what about Fairfax Financial? They just took a $449 million hit from failed short positions.
Oh, yeah, that sounds to me that they were a little too early in getting protected on the short side. So, no, that's a nasty hit, that one. But we'd have to take a look at it. But that is probably what I was talking about. I hadn't seen that news. But as I say, when markets change quickly, one way or the other, there's bound to be people on the wrong side, and then eventually it has to come out. So I don't know whether this one's going to disturb the Canadian market or not. I'd have to take a look at it.
Well, $500 million kind of smarts a bit.
Oh, yeah. That's a big ticket. But the other thing here is that you've got the decline in the U.S. dollar has become quite significant, and it's been part of the party. So yesterday I took a look at it, and this was the case in 2008. Now, the stock market did peak in October of 2007, but in the first part of 2008, you had a good rally for the stock market up to, I think, about May. And then you had the incredible speculative peak in crude oil that drove the price up to 147, which was in June. So that then, both those events were part of the weakening dollar, and you had two sell-offs as part of that bottoming pattern that drove the weekly RSI. That's a measure of momentum down to a double bottom, and this is what we're getting now. The sell-off's been quite relentless, and it's had working on the second oversold on the RSI. As to when it actually bottoms, we can't say. But let's just, again, put our imagination forward to after mid-year, when parties can become tired. And with the change in credit markets and the reduction in speculation, you could see the U.S. dollar beginning to recover. And if you look back on the charts for a couple of decades, there's a tendency for the dollar to be weak as a bull market peaks, and the dollar to be strong when the liquidity crisis hits. Now, there's a part behind this that is intriguing. As in a financial mania, which we have been in, the people who are seeking income will buy most any kind of a security. All they want is yield, and the risk is not in sight. So they will then be bidding up the price of bonds of lower grade companies in lower grade countries. And most of the debt issued is done through the financial capital, which is New York. And most of the debt written is due and payable in U.S. dollars, more or less into New York. So the bubble in the bond market, part of it represents what you can call a short position in U.S. dollars, because all of those debt obligations need to be serviced, and they needed to be serviced in in senior currency units, which is the U.S. dollar. And hey, this is not my imagination. This is the way previous bubbles have worked, and even going back as far as the 1550s, when Antwerp was the financial and commercial center of the world, and London was a lesser country and a lesser market, and Gresham was Queen Elizabeth's financial agent to the money market in Antwerp. And his letters, Burley was head of the Chancellor of the Exchequer and the money guy, essentially explains, listen, you don't want to owe a lot of money into Antwerp when the British pound was weak. So Elizabeth got the idea, and they gradually worked the sterling up, and then it was easier to meet their obligations in the money market. And of course, this is the same thing now. If you Canadians owe money into the U.S. in U.S. dollars, and the Canadian dollar is weak, and the U.S. dollar is going up, whoa, that's bad news. But then this gives an opportunity for very safe money. We've always got to find a place where you can't get hit too hard when bad weather comes. And that, we like to point out, is when the storm hits or before the storm hits, you want to be long, 3 to 4 year investment grade rated corporate bonds in the U.S. You'll get some income, and the price risk is minimal, and then you'll probably get a pickup in the U.S. dollar going up relative to the Canadian. So, but that's at the time for when a storm may be coming, and yes, a storm may be coming, but not quite right away. So there are opportunities for people to do safe things with money, and get a decent return out of it with not huge amounts of risk. So, and of course, what you're doing then is preparing for when everybody's laying on risk these days, and for the time when everybody's trying to get out of risk. So these things, I guess, Jim, become inevitable.
We'll have more with Bob Hoye right after the break.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com.
Welcome back. We're chatting with Bob Hoye. Bob, copper has remained remarkably strong through all of this. It's at 326, up just a bit today. Why has copper remained so hardy, even though other things were taking a pounding a few weeks ago?
Well, this is all part of the industrial commodities. I just took a look at the 5 base metals in London. Aluminum, copper, lead, zinc, nickel, and they've been firming. They got set back for a few weeks with the hit in the marketplace, but generally, now you had a low for copper. I think it was right at the end of November, maybe the middle of November. Now seasonally, you can have a low for copper in November, and seasonally, you can have a high around March. So this is what we were looking at back in November, that the general market could recover into March, and of course, the hit came in due to the failure of the mania in Bitcoin, but nonetheless, you still have that seasonal pattern in there whereby copper can be firm into March and then correct. And again, remember the November low for copper. also we want to keep in mind that crude oil can have a seasonal low sort of in December, January of each year. So this is why our caution for after mid-year. Industrial commodities may not be helpful. It's a time when credit spreads can go adverse. It's a time when the yield curve can go adverse, and we want to keep these things in mind for when it does change. And it's fascinating, Jim, to watch over decades of charts to see these seasonal moves. Now, some years they can be minor, and some years they can be major. So we'll just see what happens to this one. But your question about the bounce in copper now is appropriate, and I would just simply say the seasonal bounce into March. So and we'll see what it does for the rest of the year.
Well, I know a few years ago people were speculating in copper the way they would in gold, just stockpiling it without a market for it, and they took a big hit.
Oh yeah, well of course the history of exploration in British Columbia, for example, is that through the 40s and 50s and 60s, base metals were doing well. So the whole exploration groups all went through looking for base metal properties and ignoring gold. And then in the late 70s, when gold was soaring, I remember doing some financing for some guys on a gold prospect, and we had trouble finding a mining engineer who had any experience in gold, because all the young guys then were up on base metals. And so we found an old-timer, so to speak, who was familiar with gold properties. And then you went through the boom in the 80s for precious metals. That then put base metals on the back shelf. And so here we are now. Of late, base metals have been acting reasonably well for that's just the last year. But the big high for base metals was that speculative peak into 2011, and that was also the major high for precious metals as well. There was all kinds of technical signals at that peak for both base and precious metals. But on the longer term, I think gold is basing for an extended rally. It would be a cyclical rally because gold's real price does poorly in a big boom, financial boom, and gold's real price has done poorly since 2011. And it's basing in here now, I think, in preparation for a cyclical bull market when this financial mania rolls over and dies, which it will eventually. But that's, in the past, the best bull markets, or let's call it this way, outstanding bull markets have occurred in previous post-bubble contractions. And I'm quite convinced it'll happen again, that at some point, as gold will be in an identifiable uptrend, the gold sector will be in an identifiable uptrend, and so will the gold stocks. And one's better off to play the gold stocks because you get the leverage over any change in the price of gold. So the market's getting ready for the next major bull market in the precious metal sector.
Bob, thank you so much for chatting with us.
Well, there we did it, Jim, and it's always good to be with you, and look forward to next week.
No blood, no injury.
Of course.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. If you have any questions for Bob or any of our other guests, you can send them to info@howstreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.